Depreciation refers to the decrease in value of a capital asset over time as the asset's used and consumed. The Internal Revenue Code allows taxpayers to deduct depreciation from gross income in some circumstances. But if a taxpayer uses an asset in the construction of another capital asset, depreciation related to the construction isn't immediately deductible. The court explained why in Commissioner of Internal Revenue versus Idaho Power Company. Idaho Power Company was a public utility that produced and distributed electric energy. The company owned transportation equipment that it used in its daily operations. The company also used the equipment in the construction of the company's capital facilities, including transmission lines and switching stations. In its 1962 and 1963 federal income tax returns, the company claimed a deduction from its gross income for all the depreciation in the equipment's value, including depreciation that resulted from using the equipment in constructing the capital facilities. The company claimed the deduction under Internal Revenue Code Section 167A, which allows a deduction for the depreciation of property used in the taxpayer's trade or business. The company calculated the depreciation based on the assumption that the equipment had a useful life of 10 years. After an audit, the Commissioner of Internal Revenue disallowed the company's deduction of the construction-related depreciation. The commissioner said that under Section 263A1 of the Code, deductions aren't allowed for capital expenditures or amounts paid out by the taxpayer for new buildings or permanent improvements that increase the value of the taxpayer's property. Instead, the construction-related depreciation must be added to the company's adjusted basis in the facilities that the equipment was used to construct. Depreciation could then be computed and deducted based on the useful life of the facilities, which was at least 30 years, rather than on the 10-year useful life of the equipment. After the commissioner's adjustments, the company had a tax deficiency of over $120,000. The company challenged the commissioner's decision in tax court. The court upheld the decision, but the Ninth Circuit reversed, holding that the commissioner should have allowed the deduction. The United States Supreme Court granted cert.